This week, the market delivered a masterclass in human irrationality. Tuesday's violent sell-off, followed by Wednesday's euphoric reversal, had nothing to do with fundamentals and everything to do with psychological whiplash. The same traders who panicked over tariff threats bought back their positions 24 hours later when those threats evaporated. Netflix collapsed 4% on modest guidance misses, while Procter & Gamble rose despite missing revenue. Intel plunged 13% on weak outlook, while gold hit all-time highs above $4,900. This is not rational price discovery. This is exploitable human behavior. The crowd reacts emotionally to political theater while ignoring the actual economic data. GDP was revised up to 4.4%. Jobless claims remain near 200,000. Consumer spending stays resilient, yet a Danish pension fund selling 100 million in treasuries becomes front-page panic. The system rewards those who separate signal from noise, not those who chase headlines. Let me show you exactly how this week's chaos creates opportunity through 3 layers of market behavior that repeat with clockwork precision. The human layer reveals our species' core weakness, the inability to distinguish temporary noise from permanent change. Tuesday's 2% drawdown in the S&P triggered stop-loss cascades across momentum strategies. Participants who spent months conditioning themselves to buy dips suddenly faced a narrative they had not priced. The VIX spiked to November highs as derivative hedging flows overwhelmed spot liquidity. This was not prudent risk management, this was contagion driven by headline reflexivity. Wednesday's reversal exposed the market's bipolar relationship with uncertainty. The tariff reversal catalyzed short covering and systematic releveraging, producing a 1.16% bounce. The same participants who fled on Tuesday re-entered within 24 hours, not because fundamentals shifted, but because fear evaporated as quickly as it materialized. This emotional whiplash is the hallmark of a market operating on impulse rather than conviction. The small cap outperformance for 14 consecutive sessions against the S&P reveals late cycle positioning psychology. Participants are hunting for asymmetry in overlooked names rather than chasing momentum in crowded megacaps. Gold's relentless march reflects deep-seated distrust in fiat stability. This is fear of systemic fragility, not inflation expectations alone. The system layer shows how these psychological patterns create exploitable inefficiencies. The divergence between large-cap tech and small-cap industrials reflects structural capital reallocation. The Russell's 14-session streak is statistically significant and suggests institutional flows rotating out of valuation-stretched megacaps into domestically exposed cyclicals. This is portfolio rebalancing ahead of potential fiscal stimulus, not sentiment-driven speculation. The bond market revealed the system's most critical tension. The 10-year yields climbed to 4.27% despite Fed rate cut expectations indicates term premium expansion. The breakdown in traditional correlations between equities and treasuries during Tuesday's sell-off was a liquidity event. When both risk assets and safe havens sell off simultaneously, cash becomes the only true safe haven. Earnings season exposed valuation discipline. Netflix and Intel's collapses demonstrate zero tolerance for execution risk, while Procter & Gamble's gain, despite revenue misses, shows the market rewarding defensive positioning. The system is bifurcating, punishing growth disappointments while rewarding resilience. Here's what most people don't realize about this environment. The disciplined approach is not to predict the next shock, but to position for resilience regardless of the shock's origin. The participants who sold Tuesday's lows and bought Wednesday's highs paid the volatility tax twice. The participants who held through both sessions paid nothing. This is the natural advantage of process over impulse. The rotation from megacap tech into small caps is not a trend to chase. When the Russell outperforms the S&P for 14 consecutive sessions, the move is already priced. The opportunity was weeks ago. The disciplined approach is to observe the rotation, understand its drivers, and wait for the next dislocation to deploy capital where others have fled. The market is transitioning from a liquidity-driven regime to an earnings-driven regime. This favors discipline over speculation, quality over momentum, and patience over activity. The system rewards those who survive volatility, not those who predict it. This means holding cash, avoiding leverage, maintaining exposure to uncorrelated assets, and refusing to chase momentum in crowded trades. The week's volatility was not an anomaly. It was a preview of operating with compressed risk premia and political uncertainty that defies quantification. If you value systematic thinking over emotional noise, subscribe for frameworks that exploit predictable human behavior. Download the complete Stoic Exploiter methodology in the description below.